Unless there's something extraordinary, another government shutdown, and it's something extraordinary happens, really by the end of next month, we should start seeing much higher crypto prices. You know, it's coming to that point now, because if you think the election's in November, they have to get the ISM from 47 to like 55 or 57 in the shortest period of time. They're going to give out massive fiscal stimuluses. They're giving tax breaks, and they're giving the banks the ability to use more leverage. That should start flowing.
If you've been staring at crypto charts lately, wondering, why does this feel so wrong? You're not alone. Everything else is ripping. Gold, silver, stocks, even copper. And yet crypto has been left for dead. That disconnect is exactly where Raoul starts sounding the alarm. In his latest interview, Powell makes a bold, time-specific call. If nothing breaks at the macro level, crypto prices could begin accelerating sharply as early as the end of February 2026. Not because of hype, not because of narratives, but because the same forces already driving gold and stocks higher are quietly lining up behind crypto, and they always arrive late, fast, and violently. Now, you might be thinking, we've heard this before: liquidity, cycles, catch-up trades. But here's what makes this moment different. Raoul isn't guessing. He's tracking where money is already flowing, and more importantly, where it hasn't flowed yet. Precious metals are signaling something is breaking beneath the surface of the global system: currency debasement, fiscal pressure, political urgency. Historically, crypto doesn't lead that move. It lags, and then it explodes. Powell's core message here is simple, but uncomfortable. Crypto looks weak not because the bull market is over, but because it hasn't even started yet. In this video, we're going to unpack why crypto has been left behind, what has to change for that rotation to begin, and how regulatory clarity, liquidity, and macro pressure could flip the entire market narrative in 2026. If you find this kind of deep, macro-driven crypto analysis useful, hit the like button, subscribe for more, and stick with us. Because what comes next is where this story gets really interesting.
Let's talk about liquidity. Last year was a year where everyone was, including myself, was expecting more liquidity. It tends to come in seasonal phases. Liquidity is generally being used to debase the currency to pay for the debts, and particularly the rolling of this massive debt load. That had been a 4-year cycle, and then last year it started. We didn't see the pickup in liquidity we're expecting. And that led me to try and understand what was going on, why it had changed versus my forecast. And I realized that the debts had been extended by another year, so therefore the cycle was probably a 5-year cycle. Okay, so that gave us an understanding. We should have still had a good end to the year. Normally, Q4 is good in crypto, or at least November, December is, and it wasn't. It was the opposite happened. And that was based on, again, liquidity, because we had the government shutdown. And the government shutdown, well, it first started in July, where the Federal Reserve, planning for the potential shutdown, started rebuilding what's known as the Treasury General Account. That's their checking account. When they do that, they're taking money out of the system. It used to be offset by something called the reverse repo, which they'd been draining over the last 2 years, and that was empty. So you had a slightly outsized effect. Also, Chinese liquidity hadn't picked up yet. So we had this liquidity air pocket. Okay, that's pretty normal. These things happen. Then we had the shutdown. Nobody expected the longest shutdown in history. Certainly I didn't. And what you got was a decoupling of crypto, which is the furthest end of the risk curve, because it got hit by this lack of liquidity because nobody could spend any money in the government. So liquidity wasn't there. That caused October the 10th. October the 10th was a crypto-specific event where everything broke basically on Binance and a few of the Asian exchanges, and everybody got liquidated, the largest liquidation event in history, and the market has not recovered from that yet. There's a bunch of theses why it hasn't recovered yet, but it's repairing itself, which is why we've had this choppy sideways price action for a long time while other assets have been screaming to new highs. Does it mean that it's over and the 4-year cycle's over? No. Because we can actually forecast liquidity. We do it a number of ways. One is look at financial conditions. They're weakening, and the dollar at a new low for this cycle today is a huge indicator that financial conditions are weakening. Bond yields over time have been either stable or trending lower. That's another input to liquidity. Commodity prices are starting to pick up. which is a slight offset. But generally speaking, financial conditions are improving. That leads global liquidity. And that in itself leads market prices. So looking at global liquidity, we know it's going to go up. We also know that the interest payments on the debt are still going vertical, so we can tell how much they have to roll. And they've got about 8 trillion to roll this year. So somehow you need to find 8 trillion. So what we've seen is a battle between the central bank and the government. Basically the rights to who debases the currency. Because if the central bank does it, they're not necessarily going to do what the government needs to issue more debt, because the government wants to spend money, give fiscal stimulus, do what it wants to do. And the Federal Reserve will say, well, inflation and unemployment, we're not going to do that. So what we've just seen is the start of a regime change. And it's always comes in these little 3 or 4 letter acronyms that nobody understands. And this was the ESLR. Oh, they've changed the requirements on the ESLR. Means nothing. Actually, it's the risk weighting of government bonds in bank balance sheets. And what it means is after 2008, they became very strict about how much leverage banks could take under this thing called the Basel III Accord. This is part of that. But if you change the risk weighting, it automatically allows the banks to absorb more bonds from the government. So they can issue more and the banks buy them directly. So you're not waiting for the Chinese to buy them or the Japanese or the Europeans or whatever. So that was part of the smoke and mirrors. The other thing is what happens is the banks use leverage and create more liquidity. So banks can create money too. And this process allows them to take more risk, add more leverage. So this is the way they're going to start financing this. We've got a bunch of other measures coming through, but that's the main one. In addition, what this does, it picks up the business cycle. We've seen this K-shaped economy where Main Street is basically in recession or near as damn it to a recession, while Wall Street has had a boom. And that's because the ISM, the business cycle, the Institute of Supply Managers survey, is still below 50. So they know they want to win an election. They need Main Street to feel like it's got money and it's feeling like the economy's growing. So when you give the banks the ability to leverage up, they'll lend it to small businesses. They'll create economic activity, which central banks don't create economic activity. They just debase the currency by using the balance sheet. But the banks debase the currency and create economic activity. That's why they're doing this. So we've got this thing where economic growth is going to get stimulated by fiscal stimulus, bank leverage, plus what's happening in AI, and also the building of data centers, the whole infrastructure build out, all of this. And then on top, they've allowed for the debasement of currency to happen, which increases liquidity. So by all accounts, all of those measures tell you that 2026 should be a good year. But then everybody in our markets, sorry, this is a long soliloquy, but there's important points to get across, is everybody in our markets looks across at gold and silver and go, what the f***, man? This is supposed to be our party. But you see, gold actually mirrors financial conditions. So it leads and has done for the last 8 or 10 years, it leads crypto. So it is mirroring these financial conditions which are loosened, and eventually crypto plays catch up. There's still a bit of a dislocation between crypto prices and global liquidity because of what happened in 1010. But when you look at all of this, the probability is that those alligator jaws, the difference between, let's say, global M2 and crypto, or gold and crypto with the lag, all of this, all close. So that's what I think is about to happen. We've only got one more problem in the way. There's always a problem, which is, can we get another government shutdown? It'll be a partial shutdown, but the market doesn't like that either. So we need to get through these things. And then before you know it, the whole thing is going to be, how did the Republicans win the election? And therefore, how do they print money? But it's also not a US game. So the Chinese are already accelerating their printing of money. The Europeans aren't doing much. And the Japanese are doing a different game, which is stimulating growth. But net, probabilistically speaking, this should be a very good year.
What Pal hints at, without fully spelling it out, is that crypto's underperformance isn't random, it's structural. Liquidity didn't disappear, it simply went elsewhere first. We've seen this movie before. Gold moves when confidence in fiat cracks. Equities move when liquidity needs a home. Crypto only moves when the system feels forced to take a risk. Analysts like Raoul Lynn Alden, and Julian Biddle have all pointed to the same tension. Financial conditions are easing, but crypto remains impaired. That tells us the issue isn't demand, it's access, confidence, and timing. And that's exactly what sets the stage for what Pal explains next: how market breaks, forced liquidations, and structural damage can delay, but not cancel, a bull market. He begins with the October 10th crash and how badly it is still impacting crypto prices to date.
So we've had similar in the equity market. It was called the flash crash in 2014, I think it was. And big stocks traded down 80% in like 3 minutes. Yeah. Exactly the same mechanism. And there was a break in the market. Did that stop the equity bull market? No. Did it take a while to digest the mess? Yes. They had to cancel a bunch of trades and, a lot of people had lost money in it. It just takes a while. Now, why does it take a while? So this is my thesis on it. It could be dead wrong. Let's assume the core of what happened on Binance. It was the Athena peg breaking because they referenced it differently. Whatever the mechanism was, in the end, even the APIs to the market makers broke. So there was no prices able to be made. So everything just hitting stop losses, hitting exchange liquidations in perps, and everything gets liquidated, but there's no buyer because the market makers weren't able to put prices in, nor were we. Remember, everyone was trying to buy. You couldn't get a single price in, but everything was being automatically liquidated. My view is the exchanges, Binance and others, had to step in with their own balance sheets to stop the market completely going to zero through their own, the failure of their own platform. So let's say a big buyer, people thought it was the market makers. I think the market makers actually got quite impaired by this. But let's say Binance has to chuck in, and again, I don't know if I'm right, but let's say they had to chuck in $10 billion to absorb all of that selling. Okay, now they've got $10 billion of inventory. They have a big shareholder in Abu Dhabi who, they need to be careful what they report and stuff like that. So, okay, they've done this. What do they need to do? They'll need to offload the risk. But you've got a bunch of shit coins. You've got a bunch of everything in that. And some of this stuff is not liquid at all. And you've taken out a bunch of retail investors and broken their hopes and dreams. So it's going to take a while for them to try and sell that and repair their own balance sheet. They probably didn't lose money from it. They're smart enough to figure out how to get out of risk over time. But I think they had a lot of risk that they had to absorb. And that's what's kept everything held back over this period is this. And we saw it every day. We'd see this selling. And that is coming, I think, from this whole situation.
How do you see retail coming back at this point in time?
Retail is driven by the fastest possible returns. If you go with the thesis that most retail investors, the Robinhood crowd and the Coinbase crowd, they're generally in their 20s and 30s. They generally can't afford a house. They're generally working 2 or 3 jobs. And they're looking for a way out. And so they will speculate. They're also a gaming generation. So losing your life is not the end of the world because you lose it in games and you start again, right? They grew up on gaming. So it's a risk-taking culture. And it's a logical risk-taking culture when there's no way of getting out of the trap unless you take risk. So they just move where the returns are. So they're all on Robinhood trading options on Palantir and tech stocks, and then gold and silver start going, and they start trading that. So if the returns start coming back to crypto, and we know that over time crypto's outperformed. I posted a chart on X recently about the gold crypto ratio. I mean, since 2020, I think Bitcoin's outperformed gold by 87.5%. So as soon as crypto starts moving, it has that supermassive black hole effect because it outperforms everything and it just sucks in capital. So they will be back. They didn't leave crypto forever. They just lost their stake at the casino. And if they've got a stake, they went elsewhere to the different casino. And they'll come back to whatever casino pays the best odds.
I want to dig into this, Bitcoin will catch up to gold idea.
Gold is coincidental to financial conditions. So really, I'm using the macro framework of financial conditions leads liquidity. Financial conditions is there as the lead into the need for debasement of currency via liquidity. That's driven by the interest payments on the debt and the debt that needs to be rolled. So it's all a macro thesis that rolls down through asset classes. And it rolls down according to the business cycle where you've got some assets that lead, some lag. Gold leads currently. So it's not about gold, it's about the business cycle. Gold is just an easy way of looking at it. And in fact, if you put the charts of Bitcoin and gold with I think it's a 180-day roughly lag, they actually match up very well. But what you found is you've got this slight alligator jaws, and the alligator jaws is the impairment of the market that's only in crypto. So therefore, it's a temporary state of affairs, most likely. And you see, if the market starts performing better again, almost everybody in crypto is underweight now, because half the market thinks the bear market's in play and the cycle's done. And if the market starts ripping from here, everybody's kind of underweight, so they'll chase it.
I'm going to play devil's advocate one more time before we move on, talk
please.
about 20, 30, 5-year cycle. What would be the first signal that you're wrong about the 5-year thesis?
I really think that unless there's something extraordinary, another government shut down and it's something extraordinary happens, really by the end of next month, we should start seeing much higher crypto prices. It's coming to that point now, because if you think the election's in November, they have to get the ISM from 47 to like 55 or 57 in the shortest period of time. They're going to give out massive fiscal stimuluses. They're giving tax breaks, and they're giving the banks the ability to use more leverage. That should start flowing, unless something is astray here. Now, could it be something to do with the tariff thing? Possibly. There's always something that can go wrong. There's nothing is a certainty. Everything is a probability, and there's always an unknown that comes into play. Could be a positive unknown, could be a negative unknown. The flip side of that, we've got the Stability Act. Does that get put through? We don't know. I mean, last week, I had a call with some of the people in the US government, and they're like, if we don't get this through now, it's not going to go through for 6 years. And, we're not sure we can get the Democrats across the line. Next minute you hear it's close. So I don't know where we are, but if that comes through, the guys from Bitwise have talked about this. It unleashes a lot of capital because it really gives clarity on what is what. And a lot of people, particularly the banks and the asset management firms who are creating products in the space, really need to know this.
Let's take a moment to zoom out, because the macro picture right now is impossible to ignore. The US dollar is weakening fast, and not quietly. Since the Fed's rate checks and renewed yen intervention rumors, the dollar has been sliding, nearly 13% down over the last 12 months, breaking levels not seen since early 2022. What's different this time is that institutions aren't brushing it off. The IMF has openly confirmed it is stress testing scenarios involving a rapid sell-off of US dollar assets, even modeling what it calls unthinkable outcomes. And this isn't coming out of nowhere. Raoul has been calling for a deliberate weakening of the dollar since early 2025, arguing it would be politically necessary under a Trump administration trying to stabilize growth and service exploding debt. Trump himself recently said the dollar is doing great, even as it continues to trend lower. History tells us this is exactly how these shifts begin. Before the 1985 Plaza Accord, the dollar weakened on signals and rumors long before coordination was ever announced. Now look at the response. Gold just printed another all-time high. Silver has gone vertical. Copper is moving. The S&P 500 is at record highs. Every major asset class is green, except crypto. Bitcoin, Ethereum, altcoins, total market cap, all deep in the red over the last year. That makes crypto the worst performing asset class in a period defined by monetary debasement. So what gives? One explanation is regulatory paralysis. Institutions don't chase narratives, they need rules. Until the US provides a clear market structure, serious capital stays cautious. That's why developments like the bipartisan crypto market structure bill moving through the Senate Agriculture Committee matter so much. Giving the CFTC authority over non-security digital commodities isn't just a legal tweak, it's a signal. And if this progresses toward broader clarity legislation, it unlocks the exact institutional participation that's been missing. The other explanation, and this one is far more controversial, is market structure and positioning. There's a growing belief among traders that large institutions and exchanges are actively suppressing price discovery in crypto, not because the asset class is broken, but because it's still being accumulated. You've probably noticed it yourself. sharp sell-offs at predictable times, heavy spot and derivatives pressure during thin liquidity windows, and the now infamous 10 a.m. dumps that seem to appear just as momentum starts building. Is this proven coordination? No. But when firms like BlackRock, major market makers, and large exchanges are simultaneously building infrastructure, filing products, and expanding custody, while price remains pinned, it raises an uncomfortable question. Are prices weak because demand is gone, or because smart money wants more time to position? If metals, equities, and even industrial commodities are already pricing in currency debasement and liquidity expansion, then crypto stands out as the last major asset class not reflecting that reality. And unlike gold or stocks, crypto is tiny by comparison, barely a few $1 trillion against markets worth tens of trillions. When capital finally rotates out of overcrowded, overextended trades and into an asset class that's been left behind, the move doesn't come gently, it comes fast, especially once regulatory clarity removes the final excuse for institutions to stay on the sidelines. At that point, price doesn't grind higher, it reprices. And that's the bet Raoul is really making. If this analysis helped connect the dots for you, hit the like button, subscribe, and let me know what you think in the comments. Is crypto being ignored or deliberately held back? Thanks for watching, and see you in the next one.